Hello and welcome back to Bell Financial Group's From the Helm series. I'm Grady Wulff, Senior Market Analyst with Bell Financial Group. Infratil is a New Zealand-based infrastructure investment company listed on the ASX. It owns renewable energy, digital infrastructure, airports, healthcare assets, data centres and much more, with operations in New Zealand, Australia, Asia, the US and Europe. So truly a global company. To tell us more about the company, I'm very thrilled to be joined today live from New Zealand by CEO Jason Boyes. Jason, thank you so much for joining us today, and can you give us an insight and overview into what Infratil is and does?
Sure. Hey everybody. Infratil is an infrastructure investment company, and we're managed by a specialist infrastructure investment manager, Morrison, who I work for. We take control or negative control positions in almost always unlisted infrastructure businesses with either strong cash flow to keep the lights on at Infratil and also give us balance sheet flexibility, or a strong growth profile to generate strong compounding returns over the long term. And so although it's important to keep the lights on, obviously, we're fundamentally growth oriented. That's an important thing to know about us. Looking to allocate our incremental capital at mid-teens plus levered equity IRRs, so 15% plus. Because we're investing long term, we're actually fundamentally thematic driven. So we're looking for sectors with attractive market structures driven by long-term growth trends, and we can get into that a little bit later. But then once we're in businesses, we take almost like a private equity-like approach to management of them. We work through the board to set strategy. Remember, we have control or negative control. We select and incentivize the key management, and we control capital allocation. And within Morrison, we have people with deep sector expertise in our sort of highest conviction areas to help us do all that. And we also get our businesses, a little bit like private equity, to spin out or sell divisions if we think that will help optimize returns or increase management focus, or work towards strategic mergers over time. So one of our oldest investments is in a business in New Zealand, a hydro generator, used to be called Trustpower, now called Manawa Energy. It merged this year with Contact Energy, another big generator business here in New Zealand, after spinning out its renewable development business 5 years ago and its retail business 2 years ago, just to give you a sense of how active we can be in shifting and shaping our businesses to earn attractive returns. We're essentially constantly working on that portfolio to extract the best operating performance or best return for our dollar in terms of where it's allocated, and we're repositioning the portfolio over time into sectors that we think have stronger cash flow generation or growth over the long term. Hopefully that gives you a short picture of what we do.
Now, what is the history of the company and how long have you been around for, including the relationship with Morrison as manager?
So Infratil has been around for over 30 years. Morrison, which is the specialist infrastructure investment manager I mentioned, established Infratil in 1994, when it was listed.
That's my age.
yeah, like a long time ago. We had our 30th birthday last year, which is a pretty big deal when you look at the numbers of companies who were around 30 years ago are still around today. So listed in 1994, actually as a $50 million Kiwi cash box, which you probably couldn't do today, and has now grown to sort of 11-12 billion of market cap over that 30-year period. Morrison itself, it's important to understand this, was established in 1988, a little bit longer, but it is now today a specialist global infrastructure investment manager. That is all we do. We're about 200 people spread globally now, and Infratil is our obviously oldest and by far biggest fund that we work on. Infratil itself in 1994 started with investments in, I guess, what you would call today sort of core or traditional infrastructure that was being privatized at the time. So I mentioned Trustpower before, which we sold this year. So we held on to that for 31 years. We've held investments in ports that were privatized then. Shell's downstream fuel assets, which is now owned by Ampol, a name your clients will know. We still own Wellington Airport, for example. But sort of halfway through our 30-year journey, we then started investing in these, offshore outside New Zealand with a more growth orientation into the assets that we're probably going to talk about in a second that were kind of more relevant to our growth long term.
Now, what is the targeted return for Infratil and how has the company performed over the long term?
We publicly target 11 to 15% compound annual growth over a rolling 10-year period. Actually, our track record over the full 30 years is more like 18 to 20%. And actually, over the last 5 years, say, to give you a clearer picture of it, is above 20%. We measure that per annum. We measure that through total shareholder return. So it's share price growth and dividends. By far and away, most of the growth for us comes through share price growth. So we're growing the value of our assets. We do pay a small dividend, which we're quite committed to. I think the yield today is something like 2%, to give you a sense, but most of the growth is coming through that capital accumulation, through the compounding effect I talked about before.
In the current market environment, why should investors consider infrastructure exposure in a well-diversified portfolio?
The selling points for adding infrastructure to your portfolio, if you don't already have it, would be two for me. One is the downside protection you get. Now, nothing's perfectly safe, so don't get me wrong, but you do get downside protection from investing in real assets like infrastructure that can, through most economic cycles, cover your annual outgoings. So if we look back through our history at Infratil and Morrison at investments that have not gone well, and everybody's got them right, we've still managed to get, in almost all cases, get our money back and reallocate that to the next good idea. So actually today we announced selling an investment in Retire Australia, which is something we've owned for 10 years. That has been a difficult investment for various reasons, but today we announced that we've sold it at a price that means we get all our money back, which we can then now reallocate to some of our better ideas today. So that's one, I think, key selling point from infrastructure investing done well. The other one is that you should see through these businesses less correlation with general economic conditions. It's not perfect, but for example, at our airport, people fly, whether or not the economy is growing super fast or not. Now, they'll fly a bit more if it's going well, but in general, you're just going to see less correlation than some other types of businesses, which enables you to stay in the market over long periods of time, which is a really big leading indicator for earning outsized returns over time. And then lastly, I'd say about our approach is you can still be exposed to decent growth, as our track record shows. We're pretty proud of 20% over the last 5 years and nearly 20% over 30 years. When you compound that over a long period of time, you end up with a crazy money multiple. So you're not necessarily giving up tons of growth for a bit more downside protection.
Now, what are the key thematics driving the portfolio makeup?
We're quite focused on two big thematics at the moment. These have changed over time for Infratil, but today it is digitization, and particularly the growth of data centers driven by, for a long time over the last few years, the shift to cloud applications and use of the cloud for businesses and you and I at home. And then more recently, AI has sort of supercharged that. So that's one big theme driving certainly our data center investments. The other big theme that we've been invested in, actually almost for the full 30-year period of Infratil's life, is the shift to renewable energy and the energy transition. And that has accelerated at different paces in different areas around the world. Our approach is to take a global, diversified exposure to renewable energy development, that part of the energy transition, so that we can kind of ride the ebbs and flows around the world quite nicely. There's always somewhere in the world where people are building more solar farms and wind farms, and the trick is to be exposed to that globally. So those are the two big themes we like the most at the moment.
Now, you briefly mentioned data centres there. You have a considerable data centre portfolio via ownership or part ownership in CDC. Can you take us through what CDC is and how you are seeing the data centre thematic play out in Australia?
Yeah, it's a big deal for sure, and certainly for Infratil. So CDC is an Australian-based data centre business, one of the biggest in Australia. It is owned 50% by us and 50% by Australia Future Fund and Commonwealth Super. So all of you out there in Australia who are listening own a part of CTC. We see data centers as, the fundamental infrastructure of a modern economy. And we invested in CDC 8 or 9 years ago before they were really even understood in that way. But everything that's happened since has confirmed that thesis, whether it was, as I said, the massive shift to cloud computing that happened, really actually accelerated by COVID, is when it really pushed everybody into cloud applications so we could all work from home effectively. And then that has been supercharged in recent times by huge demand for large scale campuses for both AI specific applications, but also just AI augmentation of the cloud workloads I talked before. So whether it's the little Copilot logo that's popping up in all of your Microsoft applications, or actually within all of the other cloud applications we already use, or whether you're actually just going to ChatGPT and using that as well. All of that adds up to massive requirements for data center space and power that CDC is incredibly well positioned to serve.
Now, renewables, as you mentioned, is another one of the key thematics. Can you outline the types of returns you can generate from renewable development and how you're exposed to the global opportunity that is definitely growing today?
This is a good question. One we get asked often. The history of renewable energy investing in Australia has not been great, and which is why we do take a global perspective. The most attractive market that we're in at the moment for renewable energy development is still, would you believe it, America, USA. There we can build a very large solar facility quite quickly within a 12 to 24-month period on hold to maturity, so 30-year levered equity IRRs that are at or well above our 15% target return. So we're very happy to continue to allocate capital at that scale for those sorts of returns. If you were invested in this space historically in Australia, or even sometimes today, you would struggle to get more than 8 or 9%. So there are definitely areas in the world where you can earn a much better return, much more attractive return than what you would have historically experienced in Australia and frankly New Zealand as well. So that is a good place to be invested, but we know the regulatory volatility there around renewables is pretty extreme, and that's happened this year. So our approach, actually, we've been doing this globally for the last 10 years, is to try and find a number of markets that we can spread out over so that we can kind of ride that volatility. So we have other businesses that are smaller, but take a similar approach to developing renewables in Southeast Asia, based out of Singapore, in Europe, based out of Milan, and actually a small new one in Australia and New Zealand as well, called Mint. And those, there's always, as I said before, there's always somewhere in the world where renewables is getting pushed. The area we're most excited about outside the US and is coming up next for us is actually Southeast Asia. There you have growing demand for electricity because of population growth and the growing middle class and all those things. But also you have still actually quite a strong push for decarbonisation in those markets, and solar in particular is still the cheapest, fastest way to get electrons onto the grid. So we talked at our full year results about actually a huge project in Indonesia to import solar power into Singapore, where they need the electrons but have no ability to generate it renewably themselves. That's been backed by the Singapore government that our business owns 75% of. And if that comes off, which we should find out about over the next 12 to 18 months, that would accelerate Gurīn from a small startup business that it is today to more or less the same size Longroad Energy was, which is for us a $2 billion investment, within a year, which is an incredibly exciting large project that I think will demonstrate the benefits and the wisdom of trying to invest in a globally diversified way in this sector, and still able to achieve our target 15% plus quite attractive returns over the long term.
And finally, why are you excited about the next 12 months and the outlook for the company? And what can investors expect on a news flow front?
Good question. We are still really positive about CDC and Longroad's growth for all the reasons you read about in the news every day, whether it's AI acceleration or AI and reshoring of industrial activity, factories, etc., are going to drive energy demand as well. So those two businesses were very positive and confident that the news flow over the next 12 months will be strong, which will support the investment thesis for everybody. At the full year results, we outlined 4 strategic initiatives alongside, continued growth of those businesses that were well received by the market, and we're working through ticking those off. The first one we talked about was selling up to about $1 billion of our existing assets to recycle that capital into growth. We're targeting businesses that can't grow to a meaningful scale within our portfolio, and using that capital within our growth businesses rather than necessarily tapping shareholders on the shoulder every time we need more money. And so today we announced the first one of those, the sale of Retire Australia that I mentioned before, and you should see more news flow along those lines, which we think would be well received as well. We talked about identifying the next growth pillar beyond CDC and Longroad, and that's that Southeast Asian large renewables project that I mentioned before. The Gurin team will be down in Australia in September, and we'll be updating investors at our Investor Day in Sydney on that as well, so look out for that. And then the last two strategic initiatives we identified, I think we'll just make steady progress on over the period. The first of those was getting our operating cash flows back in balance, and that will be helped by the sales that that we have said we're going to do, and obviously we've started on today. So that more sales like that will show progress on balancing the operating cash flows. And then we talked about broadening our investor base, which we were recently included in the ASX 200 index, which helps materially with that objective, because we need to grow our investor base to support the strong growth that I've talked about before. So that's it.
Jason, thank you so much for joining us today, and thank you for joining us for this episode of From the Helm with Infratil. If you enjoyed the episode, be sure to subscribe to our YouTube channel to ensure you're always up to date with market insights, commentary, and of course exclusive interviews like this one.